I know you've pointed out commercial bookings up 37, revenue 20, Azure growth accelerating. Fair to say that software spend right now, at least from this print, looks solid?
Yes, definitely. I think Microsoft was a very good validating data point that the overall software environment remains robust. This validates what we've seen in our CIO surveys. We published that last week, where CIOs are telling us they see dead stable software growth that was good in 2021. It's going to continue to be strong in 2022. And a lot of the same growth drivers. It's cloud computing, digital transformation, data and analytics, and the security to make sure all that takes place in a secure environment.
You're right. As of last night, software valuations hit a new low, down 38 from the peak. Any reason to think they deserve to come down from here?
I think we're getting to a place where our software valuations are looking very interesting here. Across the board, there's still some pockets where names are pretty expensive, but names like a Microsoft that's trading on our numbers at about a 1.6 times PEG ratio, that's below their 5-year average. Intuit similarly below their 5-year average on a PEG ratio. If you look at the overall group on a growth adjusted basis, that also has come below its 5-year average. So part of what we were talking about in what we call our software gut check that we published on Monday night is there are really interesting valuations in software with this pullback. You match that up with a really nice spending environment, and we're starting to really pick our places within software where we want to get more aggressive. Names like Microsoft and Intuit are some of the easiest to own in software, but there's also names like a Salesforce or a Palo Alto Networks that have really good free cash flows, and we think accelerating free cash flows that at these levels look very interesting as well. So definitely more of a buy signal from our perspective in software, given, again, strong spending environment matching up with some really interesting valuations out there.
All right, just to dig a little deeper then on the valuation, you talked about accelerating cash flows for the likes of, for instance, the Salesforce. What kind of numbers are we looking at here in terms of potential multiples versus growth rates?
Yeah, so if you, again, we were talking about Microsoft, and we look at that on a PEG ratio, is trading at about 1.6 times PEG ratio on our numbers. Historically, the 5-year average for Microsoft has been closer to a 1.9. So that's a discount to sort of how they've traditionally traded. For someone like a Salesforce, we see free cash flow growth getting close to 30% growth. And right now they're trading at an EV to free cash flow multiple. Again, on our numbers, that's closer to 28, 29 times. So less than 1 times free cash flow growth. Historically, software trades much more expensive than that. On average, it's anywhere between 1.2 and 1.8 times EV to free cash flow to growth. So names like a Salesforce and a Palo Alto Networks are actually trading really inexpensively versus the free cash flow growth that we expect. And even some of the bigger names that have a higher multiple relative to their historical levels, like a ServiceNow, which is reporting tonight, we like that name as well. Also at the lower end of this range when you look at free cash flow multiples relative to the potential growth that they could sustain.
Some actionable suggestions right there, Keith. I mean, to go back to Microsoft specifically, though, the fact that a little bit later this quarter, we are expecting price increases for Office 365, which includes Word and the Teams app. How big of a boon could that be?
Yeah, price increases are interesting for 2 reasons. One, Office and the Office commercial franchise is a big revenue number within the broader Microsoft. So there's enough dollars there to move the needle. The price increases are not insignificant. We think on average they're about a 15% price increase. The important thing to keep in mind, though, is this rolls in over a 3-year period. So we only get 1 month of it in their upcoming March quarter because the price increases start on March 1st. So that impact's pretty de minimis. It could add a point or two to Office 365 overall growth as we start to roll those out. So that could sort of shore up the growth rates for the overall Office franchise. That's a big franchise for Microsoft. So it's part of the equation. And with Microsoft, it's always going to be an equation of there's multiple components of growth here. And that's what we like about Microsoft. There's Azure, which is a great franchise. Dynamics 365 is a great franchise. Office 365, obviously a great franchise. All of these are contributing positively to growth, and the price increases are part of that mosaic, part of the kind of incremental impact that keeps us ahead of the street. We're looking for Microsoft to sustain 15% top-line revenue growth into FY23. That's more aggressive than my peers. The overall street consensus is more like a 13% growth. So that's part of the equation, is that they do have room to take pricing. And not only is that good for the top line, it's good for the bottom line, too, because price increases tend to be very high incremental margins.